Welcome to our quarterly review. We did a session on Tuesday as well, on Tuesday evening, and today I'm just going to run through the macros of what's going on in Australia in terms of economic impacts, property markets in some of the capital city markets and major regionals, what's happening with finance, and what the data is telling us, I suppose, in relation to what we can do in terms of planning what we're going to do with the future, and try and make that a bit of a quantitative analysis, if you like, rather than listening to what's in the news wires, which seems to be quite contradictory at the moment in terms of the macros from an inflationary viewpoint and what the RBA and other central banks are saying. So I think all of these things are really important when you're making decisions in relation to your existing assets or potentially acquiring new ones. So without further ado, have a look at our disclaimer. This is all general information. It's not financial advice and it's not specific to anyone's personal needs, but by all means, if you wish to reach out, we're more than welcome to assist you with your personal needs. So just as an overview for people who don't know us, we've been doing this for quite a long time. I founded the Unicorp Group back in 1988. And at that point in time, the business consisted of an advice business providing financial advice to mainly young medicos, so my peers, and then moved into the other professions and to the commercial sector, mainly banking and finance, where many of our clients then became expats over the last 3 decades. And hence we now have a number of businesses, as you can see on your right. Unicorp Partners is the advisory business, Wise Guru is our international consulting business, Smart Loan is our lending business, and Aussie Property Guru is our real estate business. So clients utilise one or all of these depending on their needs and what they have to deal with, and it's up to clients to choose. But from a background viewpoint, we found that most of our clients were actually similar in their wants and needs. So whether you're a surgeon in Sydney or a banker in Hong Kong or anywhere else, most of our clients were very time poor. They wanted to have some real estate, some residential property to form part of their overall asset portfolio. They didn't really have time to go through and do all of that, so they wanted an organisation or someone to help them with all of the facets of that, and that's when we developed our concierge service, which we charge $4,950 for at settlement if someone wants to utilise that service. Otherwise, on the other things, we have many unique attributes within the different businesses. On the lending side, we can loan up to 85%, for example, to both Australian and non-resident Australian clients with no mortgage insurance. So something like that can make a difference for someone who's wanting to purchase a new property and hasn't saved up a lot of capital, or someone who wants to increase their portfolio. Depending on the value of a property that you purchase, it could save you over $30,000 in mortgage insurance, which otherwise you would have to pay to a bank for no benefit to yourself. So they're just some of the background things, and then let's have a look at some of the pertinent questions that people have been asking us currently, and we've looked at in a sort of a different prism potentially. One of them is, and this is very topical, when is the RBA going to raise interest rates? Because at the moment, the Reserve Bank of Australia is having a fight with the bond markets, with the financial markets, where they're pricing in rate rises quite a long way before the RBA's stated date of 2024. So we'll have a look at that. We'll have a look at the impacts of employment, wages growth, inflation on that. Search for yield. And the provision of yield is another interesting one, because you can currently purchase high quality properties in sought after markets in Australian capital city markets that are either neutrally or positively geared, and that's something that most of our clients who've been with us for over 20 years recognise is something that's unusual and obviously a great outcome. Macro factors, so population growth is a very big one, and it's obviously impacted by lack of international migration currently and a dearth of international students in our universities and higher learning education places. So we'll look at that. We'll look at the work from home effects, and some of those are going to be transitory, but some are going to be long term. So we'll see which markets might benefit from that change in shift of employment and lifestyle. And lastly, but certainly importantly, what APRA and other regulators are already doing in relation to intervention in financial markets. And what people have to remember is that the regulators are there to actually look after the financial stability of the Australian banking system, not housing prices. But there have been some changes there already. So very importantly, unlike Singapore or Hong Kong or the UAE, Australia is a very large country, and as such you really need to do your research, because property markets in Perth or Sydney or Brisbane or Melbourne are all very different at any given point in time. So really important to recognise that. We utilise the MB.BS statistics, statistics from state governments and treasuries, and also CoreLogic, API Data, the National Houses, Urbis, Oxford Economics. But then we put all of that data together and put our own practical overlay in place, because otherwise it's just a massive amount of information to assimilate, and quite often it doesn't lead you to make any sort of clear decision based upon that information. So let's have a look at this. When will the RBA be forced to lift rates? Importantly, I think it's, you need to understand why the RBA is going to lift rates, and it's going to be in response to wages growth. So currently, post-pandemic, obviously there's been a massive amount of monetary stimulus and fiscal stimulus injected into the economy to support the economy, to support employment, to make employment grow, and eventually, obviously, to make wages grow. So inflation is not necessarily a bad thing, depending on how it comes to pass. And certainly for people who currently hold real assets, so property essentially, it can be a positive tailwind. But if you have a look at if you look on the screen at the bottom, the importance of maintaining lending standards, and currently Australia has very, very high lending standards. Just ask anyone who wants to go and get a loan. And even more so if they're expats, if they're non-residents. It's not really that simple or that straightforward, and that means our banking system is currently not really in any great risk of losing that stability. So the cash rate at 0.1%, close enough to zero. RBA says it's going to stay there till April 2024, and the bond markets say no, that's going to really move perhaps a lot more quickly than that. So it's something we keep an eye on all the time, and we update our clients regularly. But if you have a look at this graph from Westpac, and you're looking at there, the blue line is the Aussie 10-year bond rate. Currently this morning it's like 179. And interestingly enough, the US 10-year bond rate's actually come off over the last couple of days, so under 160. But if you see there the red line, the cash rate of 0.01%, that will over time change, but more importantly, funding costs for banks in the interim, as these bond yields rise, are going to increase. So at the moment we're seeing some of the banks, as we predicted several months ago, raising their fixed interest rates for especially 3, 4 and 5 year fixed rates, because they base those on the swap market, and they think, look, our funding costs are going to increase, we don't want to be caught short. So we've been saying to clients, if you have a portfolio of properties and loans, have a look at that, and if you need some peace of mind, certainly I think the fixed rates at current levels are still reasonably attractive and give you a lot of peace of mind for a certain length of time that's, should be sufficient for your needs. So here are the predictions from Bill Evans, who's someone I rate highly as an economist. And he actually has the RBA raising the cash rate in 2023, as you can see, moving it up to 0.75 The 3-year swap rate, as you can see, is moving. Prior to that, the 10-year bond rate, Bill thinks, or Westpac thinks, that it's going to end up at 155 at the end of the year, then move up to 2%, and 220 at the end of 2023, and perhaps not that much higher. Fed funds rate, as you can see, and they think that the US 10-year bond yield is going to move pretty much in a similar manner to the Aussie one, although currently there is now a fair amount of margin between the Aussie 10-year and the US 10-year, so it'll be interesting to see what impact that has on the Australian dollar. As you can see there, the latest actually for the Aussie dollar is 75 cents. They've got it 75 at the end of the year. That will be impacted to some extent also by iron ore prices, but other metals, coal, energy, etc. But they have the Aussie dollar moving up over the course of next year and 2023, and that obviously has some provisos to it depending on global growth. But I'm also of that mind, because currently with commodity prices where they are, one would expect that the Australian dollar would actually be higher against the US dollar. In fact, last time that the commodity price basket was at these levels, the Aussie dollar was at parity with the US dollar, just as a little bit of history. The other really important thing to look at and recognise is that, you know, our cost of servicing debt is actually very low as it's ever been in Australia. So whilst the level of debt is higher, and certainly the level of household debt is high in Australia compared to many other nations, the cost of servicing that is low. And that's a similar situation obviously for many governments around the world, where you've got either very low or negative yields in that situation. So that's going to help the overall economic outcome, and governments are clearly not in any rush to increase rates if they can help doing that, because that's going to push up the cost of funding these massive deficits that the pandemic has caused them to expand. So here are some of the factors that we look at from a property viewpoint. Vacancy rates are quite different state by state. As I said, all the economies are quite different in terms of, you know, where they're at. And you can see there some of the big falls in vacancy rates, particularly in Perth, in WA, in Brisbane. And clearly, on the flip side of that, you have Sydney and Melbourne mainly pushing those vacancy rates higher. But you've got to look at things a little bit more granularly than that, and look at which parts of the cities and what type of dwellings may be potentially skewing those numbers. And it's reasonably straightforward and also logical, because the lack of overseas migration and the loss of hundreds of thousands of international students means that inner city apartments that may be of a lower quality, so they're built for investors anyway to start with, particularly in inner Melbourne, inner Sydney, have been impacted by this. Vacancy rates have gone up, therefore rents have softened as landlords are trying to attract new tenants, and that's what's causing all of this happening here. And the other impact is internal migration. I'll come to that a little later in our review. So if we look at international migration, so net overseas migration, it peaked in 2008, over 315,000 people, and that was associated with sort of height of the mining boom, etc. But the temporary increase in international students in Australia is something that's, you know, a real issue at the moment. If we have a look at what happened to March 2020, so that was the onset, if you like, of the pandemic, migration was still 220,000. Australia was enjoying an annual migration rate norm of about 1.5 to 1.6%. September last year, it dropped to 85,000, and now we look at it as being a negative number, negative 95,000. And I'll show you what the ABS thinks in relation to its modelling. If you have a look here, you know, they think that population growth, and we've got to look at the different areas of that. So there's also obviously natural growth of the population, births over deaths. They see that climbing out, I suppose, of this trough that we're in currently and moving up, but then perhaps staying at a lower level than we've experienced in the decade prior. I don't necessarily agree with that. I believe that after this period of pandemic restrictions has been curtailed or ceases, hopefully, I think Australia is going to be an even more attractive place for people who want to migrate there due to lots of safety reasons and other perhaps qualitative issues that they may look at. But also from an Australian viewpoint, the country needs a massive amount of skilled labour and also non-skilled labour. So there'll be this confluence of factors where people will want to migrate to Australia and Australia needs them. So I think that may actually return to pre-pandemic levels rather than what the ABS has modelled there. Now this is the important part, because we don't have international migration, but we do have migration within Australia, and as I said, it's such a large nation, this is meaningful. So we look at what happens on a state-by-state basis and have a look at that chart. As you can see, Victoria's had a massive outflow of people over the last period, and a lot of those people have actually moved to southeast Queensland. That started happening before COVID. So these things were already in play then, but this has exacerbated that. And prior to COVID, there were also a lot of people moving from Sydney to, say, Brisbane for economic reasons. And that's still occurring, and I think will continue to occur. So we've got to look at what impact that has on those various state economies and local property markets contained within them. So if we have a look at what's happening here, the RBA and the regulators, APRA, are watching lending standards as credit growth increases, and we all know that has been increasing because markets are going up and people are looking increasingly to right size within property markets, or starting to also now look at the investor sector. So through August, as you can see in the latest figures we have from CoreLogic, the lending for purchases of housing fell by over 4%, but you've got to look at, I guess, the total portion of housing finance. It came off a little bit, which was healthy in many respects, but this monthly decline, it came off in the first home buyer market mainly. So a lot of demand was brought forward by fiscal stimulus, by certain measures like home builder bonus and certain other bonuses that the various states brought in last year, where many first homeowners jumped in and decided to buy their first homes. So that sector has come off, but if you have a look at the investment sector, rose and is now starting to rise in most markets, but it's still way below the owner-occupier request for funding. So the other thing that's important is what's going to cause the regulators to move if and when they do. And we had a recent, we had our Treasurer, Josh Frydenberg, come out and talk about this debt to income ratio, and 6 times was mentioned. You need to consider a lot of other factors also, I believe, because that's a pretty blunt tool. As I say quite often, you might have 2 couples and one couple's earning $300,000, as is the other, but one couple saves all their money and the other one enjoys holidays and spending money on disposables. So if I'm a lender, I would choose to lend the frugal couple more than the other one. So you can't just go on a 6 times debt to income level. You've got to be a bit more nuanced than that. You've got to be a bit more sensible than that. So if you have a look at interest only, percentage of loans that are on interest only terms, as you can see, that's dropped significantly. And that increases stability in the banking system. The loan to income ratio, as you can see, has ticked up to 9.7% above 6. Debt to income, similarly 21%. But if you have a look at the situation here, percentage of loans originated on an LVR of 90% or more, that's still trending downwards. So I believe, as we're seeing, that lending standards are strong, they're robust. Australian banking system is similarly strong and robust. and I don't think there's any cause for concern there. Most of the concern, I think, is political, and I can understand that because housing prices, particularly say in Sydney, are moving up to a level where it's making affordability a real issue again. So the other questions that we've had, and there have been many of them, regarding the proposed changes to Australian tax residency that were brought out in this year's May budget. Important to remember that these are still proposed changes. They need to be further discussed within Parliament. There's a lot of lobbying that's been going on and is ongoing, and we've certainly been part of that to try and make this a more sensible outcome, I suppose. So I'll go through and just talk about what's being proposed. So these new Australian tax residency rules are going to be based on their bright line tests. So they're going to be objective factors rather than currently perhaps more subjective factors. And it makes some sense, however, it needs more discussion, I believe, because this new 183-day test, which being a bright line, if you're 183 days or more in Australia, you'll be classified an Australian tax resident. Or if you work for the Foreign Service, as you do now, you remain an Australian tax resident. So there's no real change to that. But the changes come under these proposed new rules because they're seeking to bring in these 4-factor tests. So if you spend more than 45 days in Australia in any income year and tick the box to 2 of these 4-factor tests, which most of us would, you could then be regarded an Australian tax resident. Now, we've got to bear in mind, and most people would know this, that currently with COVID, when you're spending 2 weeks in quarantine perhaps, or even more, some of these measures may not be appropriate. So if we look at these 4-factor tests, one of them is the right to reside in Australia permanently. So you're an Aussie citizen with your Aussie passport, and clearly that's going to impact all Australian expats. The second one is you have Australian accommodation. That relates to, let's say you've moved from Australia somewhere, you've left your principal place of residence there, but you haven't rented it out. So you're leaving it for your disposal every time you go back to Australia. Obviously you tick that box. Another one is Australian family. So that relates to spouses and children under 18. And if you have those living in Australia, then again, we'll tick that sub-factor box. And the last one is an Australian economic interest. So if you have investments there, whether they be property or businesses, again, you would tick that. So really important, because I don't think 45 days may be the appropriate time frame for these new proposed changes to encompass, and it should potentially be greater than that. But we'll see what transpires. But have a look at what's written here at the bottom of your screens, because that's a very important thing. So Australia has double tax agreements with many countries. And it's interesting because it has one with China, but not with Hong Kong. So, if you're an Aussie expat living in Hong Kong or the UAE, it's quite different to, say, someone living in Singapore, where you do have a double tax agreement, because you can always use the tiebreaker test to determine where your tax residency is. So that's an important benefit, if you like, if you have that ability, or disadvantage if you don't, when you're looking at these proposed changes and the 45-day rules. So if you have a look at the current situation, you can see that on your left, and I'll go through that. But look, I'm not going to look at what happens to tax residency if you're going to leave Australia and become an expat, because these new changes could be actually quite detrimental and have the impact of your Australian tax residency sticking to you for a while if you go overseas. Clearly that would not be a great outcome for you. And on the left here, so, do you reside in Australia? Yes, you're an Aussie resident, pretty obvious. If you're not, is your domicile in Australia or elsewhere? So that's the difference between residency and domicile terminology from a legal viewpoint. Residency can be more temporary, domicile is permanent. Where do you live? Where's your house? Where does your family live? Where's your dog? Where do you, join sporting clubs, etc.? That's all important, and it is more subjective. Were you in Australia for 183 days or more? At the moment, it is far more subjective. That's not necessarily a great outcome, but the proposed changes are not necessarily a great outcome either. So I think what we've seen anyway, there's a lot of misunderstanding out there in the marketplace. And if people want some further information regarding this, by all means contact us. We can also then refer you to a panel of experts if you need specific advice for your own situation, if you're looking at moving from Australia or living overseas, not knowing what to do if these rules come into place. And bear in mind, we don't know when that's going to happen or how that's going to look when it finishes. So this was all brought about, by a Board of Taxation paper that was actually brought out some years ago. So it's been around for a while, but if you have a look at this double tax agreement, that's really the important thing. So if you're living in Hong Kong in particular, or the UAE, or any other jurisdiction that doesn't have a DTA with Australia, it's important to reach out and just be aware of some of these changes, because I think this will come in at some point in time. I'm not sure exactly about, obviously, the length of time, etc., on these sub-factor tests, but I think we need to think about and prepare for this. So more than happy for you to reach out, and we can give you some assistance with that. So this is something else we've had a lot of requests for, especially during the course of the pandemic. Also a lot from younger Australian expats, where these stimulus measures were brought forward where you gain a benefit by becoming a first home buyer. And many Aussie expats thought, well, how can I be a first home buyer if I'm living overseas? But there has been a possibility to do that if you have very clear dynamics happening in your personal life. So in other words, let's say you knew you were going to be repatriating back to Australia in 18 months. You could actually have bought a property off the plan that was going to complete around then, pay only 10% deposit, because you don't need to pay anything until completion of that home. And then you're in a position to actually move into it and use it as your principal place of residence back in Australia. So you could come up with a situation that worked. But obviously bear in mind there are provisos there, that you do have to move into that property within 12 months of completion and then live there for certain periods of time. All of these things vary on a state-by-state basis. The value of the property that's exempted changes state by state. So many variables, but I just want to bring out that it's a situation that people can still look at, and currently the saving would be in relation to transfer duty or stamp duty. So it's really...
Just a question, are we okay to ask questions as we go, or would you
no, I'd prefer it later on, Ash, if that's okay, because it just takes the trade away from it. But more than happy to answer all of those things in due course. So if we have a look at property in general, then as an asset class, it's a pretty large one in Australia. It's the largest one, it's over $9 trillion. But the value has gone up considerably, certainly since the beginning of the pandemic. But it's not unlike other countries. So if you look at housing prices in many other countries, they've gone up even further than Australia has. And our friends across the Tasman in New Zealand certainly feeling the pinch there. And there have been certain measures that have been brought into play there from the regulators, from the Reserve Bank even, that have been unprecedented. But there hasn't been a massive impact on the rise in housing prices in particularly the major markets like Auckland. So just worth bearing in mind, this is not something that's unique to Australia. It's a phenomenon that's going on around the world. These are some forecasts from Westpac again in relation to where they see housing prices at the end of this year and next year and the year after. So if we have a look at this year, at the end of this year, well, some of these things are in fact have been blown away already, like Sydney's up more than 22%. So they're then assuming another 4% next year, and then a decline of 6% in 2023. Melbourne, that's close to the money. It's not quite there yet. Brisbane, again, has increased more than this already. They're probably looking at that as the strongest market, and there are reasons for that, and I'll go into it. Perth has sort of weakened off a little bit of late, but it was going very well, and hopefully that will continue because it's one of the few markets that's still below its high water mark set back in 2014. Adelaide, Canberra, Hobart, they've all been strong, and we'll go through some of that in more detail. So if you have a look at this here, quarterly dwelling value increases have ranged from 1.2% in Perth to 6.9% in Canberra, so that's for the quarter. But they've all started to slow, which I think is a great thing because otherwise this rate of growth would become unsustainable. So if we have a look at this, you can see, these are the sort of major city markets. They've peaked, especially Sydney there, and come off. And if you have a look at some of these markets, that's what I'm saying, Darwin and Perth are the two markets that are still underwater from their previous high water marks. So it's worth just keeping an eye on all of these as they're very, very different. Then we look at it in different amounts of granularity. You look at the highest priced properties or the highest quality properties and the lowest ones, and look at how those sectors are performing. And as you can see by this chart, the top end of the market in Sydney, in Melbourne and in Brisbane and Adelaide has performed far more strongly than the lowest part. But the converse is true, for example, in Hobart and also in Darwin. So it just again exemplifies this difference in all the various capital city markets around the country. Regional markets are also similar, but we're not going to go into those in great detail now, but people can certainly reach out and ask us about those. So if you have a look at this, this is where, the peak in the market for Sydney and Melbourne was in 2017, and that has now been surpassed. And these are forecasts, again, from Westpac Economics. If you have a look at that, probably the steepest rate of rise is here, which is Brisbane. Perth is still going to go well, but from a lower starting point. And then if you have a look at some of the regionals, and you put in here, and these coastal markets, they've certainly been the beneficiaries of the work from home tailwind, where a lot of people can now work from home. So they say, well, why don't we move to the Gold Coast or the Sunshine Coast or the Central Coast of New South Wales, and we can work from there and enjoy the lifestyle that goes with that. So a pretty good outcome, really. But if you have a look at the trajectory of this, and we're keeping a close eye on this, this rate of growth is really steepening, and I think you need to be careful that you don't fall into a trap. So if we have a look at rental yields and actual base levels of rents, it's an interesting situation because we've had rental yields continue to decline. They're down to 3.3% on a national basis, even though rental values, the amount of rent people are paying, has increased. The reason for that is that the increase in the capital value of those properties has been even faster than the rate of increase in rent. So you've had this compression of yields. Not necessarily a bad thing, clearly, but something, that needs to be, again, kept an eye on, because if you're relying on a certain yield to maintain your property portfolio over time, that's pretty relevant. So as you can see there, on the capital city markets, Sydney and Melbourne have the lowest yield due mainly to the fact that you've got the highest increase in capital values, particularly in Sydney, so compressing that yield. But the other thing that you've got to look at, if you look at Darwin here, that's had an increase from, again, a pretty low base, and all the other capital city markets are relatively similar. And if you look at the regional markets, they're generally higher and always have been. So that's not just now as a result of COVID, that's been the case for many, many years in the past. Supply and demand, very important one. And as I discussed earlier, the first home buyer market has brought a lot of that demand forward. And as you can see, if you have a look at that top line, the housing approvals peaked in April this year. They're still over 26% higher than the decade average. But if you have a look at apartment approvals, they're below their 2017 peak, and they're well below their decade average. Now we've got to look at that, because the situation with medium and higher density housing is that you can't just go and buy a block of land and go and build a house. It takes a lot longer. There's massive lead time to get approvals, from planning approvals, building approvals. Then developers or builders have to go through pre-sales and so forth. So it takes a number of years for that to rectify. So something worth keeping an eye on, I think, going forward for the next 2 years. This trend of declining investor participation has bottomed, and that's bottomed in every state. It's ticking up, but still, as I said originally, a long way below where the owner-occupier demand for credit sits at the moment. And I think it'll continue to rise, because the problem at the moment is cash is not providing any yield. So I had a client ring me last week and said, look, I've got $2 million and the bank's offered me 0.2% for that. It's very difficult in this situation, and it's something that's being felt by many people, certainly by people who've saved money and are risk averse and are wanting to hold that in cash. They're really going backwards in real terms if you take inflation into account, even whilst that is very low. So something to look at, and it's something we will continue to monitor. This increase in demand from investors is not at this point in time causing any, I think, stress to the stability of the financial markets or the banks. So what does the data tell us, and how do we use it? Well, as I said, real estate does underpin Australia's wealth. Over $9 trillion. It's by far and away the largest asset class in the country, and that's why the regulators and the Reserve Bank and the government all tread fairly cautiously around making changes to this, because the impacts are so large, because so many other businesses rely upon this. Employment growth and wages growth is very dependent on having a stable situation here. So a lot to think about. This is something I'm asked quite often, especially from people living overseas, from Aussie expats, but more so, I guess, also from foreigners. What's happening in the Aussie property market? Well, there's no such thing. There are many property markets within Australia, and as I said, we need to utilise that national research to see how they're going to perform. So what else do we look at? The macro factors we've always looked at, and they're logical things. So you need population growth, infrastructure growth, and employment growth. And that's why I'll come back to where I've been speaking about movement within Australia and how important that is now that our borders are still basically shut to international migration at this point in time. If we look at the various states, so if we look at New South Wales, Sydney, it's the most populous state. It has the largest economy. It has the most diversified economy. Ask anyone who's trying to buy there at the moment, it's really hard to find value. Prices have risen quite sharply. I think prices will continue to move upwards over the course of this year and next year, but clearly the rate of growth will have to come down, otherwise it'll be unsustainable. And there are, obviously down the track, and even now, some headwinds to that due to affordability. So that's something we keep an eye on. Clearly, if people are looking to live there, right size, they might be upsizing or downsizing. That's unfortunately just par for the course, and you have to deal in that market. If you're looking to invest, then potentially you can look at other regions also. So if you look at Sydney for the month in September, up 1.9%, 5.7% for the quarter, and 23.6% for the year. So that's already above that forecast that Westpac had of 22%. And obviously dwelling values there currently at an all-time high. If we look at Victoria and Melbourne, it's had some negative situations to deal with. One of the biggest ones was the lockdown 6 or 7 lockdowns that extended over 270 days in the last year. So that's been a massive impact. The other one that's potentially more important was, this lack of international students being there, because prior to the pandemic, Melbourne had net overseas migration of around 78,000 people. Sydney 76. So they were the two major markets. The next one was Brisbane at 22. So you can see there's a massive discrepancy. So that's important. It's shown the weakest growth really of the major capitals. It's got this outflow of population. A lot of that, as I said, going to Queensland. So we look at the impacts of that. Up 0.8% in September, 3.3% for the quarter, and 15% for the year. But levels there, or housing prices, are at all-time highs also. If we look across to the other side, to Western Australia, to Perth, it's been interesting because the economy in WA is obviously mainly dependent on mining and bulk commodities. That could have been a downside in the past because it's certainly not diversified, but it's an upside now because commodity prices have been doing very well. As we said earlier, we all know, employment has been strong. There has been inflow of population into WA, but the rate of growth of prices has rebounded, and now in the last quarter just ticked down a little bit. Very low vacancy rates, so the backdrop looks good. But if you have a look at that, September growth was only 0.3%, 1.2 for the quarter, at 18.1 overall. It's still below the peak, which was reached back in June 2014, and we'll just keep an eye on see how this is going to head into Q4 at the end of the year. Darwin's in a similar position. One of the questions that we do get asked many times, I guess, is, look, should I buy an old property or should I buy a new one? And the answer is, look, it depends. It depends on many things. Firstly, what do you already own? But probably more importantly, I suppose, where you're going to add value. So for most of our clients, they're very time poor, as I said, so they would prefer something that's no touch, but it doesn't happen. So they like something that's low touch. So they don't want to be talking to property managers or tenants about repairs and maintenance or anything for that matter. So for them, a new property built, high quality new property built with quality materials, etc., generally works better, easier to rent, easier to manage, people stay there. And Australia is one of those unusual tax jurisdictions around the world where if you buy especially a high quality new property, you get a great deal of benefit because we get these non-cash deductions, tax deductions, which are depreciation allowances, Division 43, the building cost. We can write off 2.5% of the building cost per year for 40 years. And then Division 40 are for fixtures and fittings, so we advise our clients obviously to get a quantity surveyor's report. So that gives them the amounts they can deduct every year as the half-life diminishes of those items that the tax office will accept. And it can lead to significant savings because if you're an expat, your ATI, Australian taxable income, usually revolves around rents unless you have other income from other sources. So you can use not just the expenses that you actually have to pay for, like interest or management expenses, but these are expenses you don't need to pay for, but you can deduct. So you can usually end up with a very favourable income tax outcome, and you can save up your tax credits to utilise later on if you sell a property ever, or if you repatriate, and you can offset that against your personal exertion income there. So it's a pretty good situation to have. Conversely, let's say you're involved in construction or building or have expertise in that area, you may be coming to the stage where you're considering retirement, then an old property where you can actually add value might be really relevant for you. So it just depends. So let's have a look at what the current data is telling us, where we think is perhaps a better place to invest, and the easiest pie I'll come to very shortly. So we think that's Brisbane or southeast Queensland. We have thought so for a period of years, and there are many reasons for that. that have been playing out prior to COVID, but have been, I suppose, really, the spotlight having pointed on them now. So Queensland does have a very diversified economy. It's very similar to the Australian national economy in terms of contributors to GDP. The important thing, I guess, is it's got this massive valuation gap that still exists, even though prices have moved up, between Sydney and Melbourne. And now we're seeing this, this work from home lifestyle factors becoming a real tailwind, where, as I say, people are looking at the coastal markets, particularly the Gold Coast and the Sunshine Coast, and we've seen the strongest interstate migration for over 15 years. That was starting beforehand, and it was then fueled, I suppose, by the effect of employment growth, which was lacking prior to that. So if we have a look at what's happened in the last quarter, Brisbane's up 1.8% in September, 5.9% for the quarter, and just under 20% for the year. So, but don't forget, it was starting from a much lower base than Sydney or Melbourne. So that valuation gap is, I think, even more relevant now. So, let's have a look at this interstate migration. And growth in population, as I say, comes from natural increase, the lighter blue bars, and then interstate migration and overseas migration. And as you can see there's been a pretty massive outflow, particularly in Victoria, also in New South Wales, and the major beneficiary of that has been Queensland. So that's important from a longer term viewpoint, what's happening there, demand for housing, etc. The last time we saw something like this was, the peak that was led up from, say, 2000 to 2004. That was the last time anything really happened in that market in terms of housing values of any note. And I think we're in a period now where that's likely to play out again. And that's certainly what the numbers have been showing us. We've been saying that for a couple of years, probably longer now, and that's what's starting to occur. So, easiest pie, population growth. The I is infrastructure growth, and there's a lot of infrastructure that's already underway. Some of it's just completed, like the parallel runway at Brisbane Airport. Clearly hasn't been a very important feature for the last 18 months, but will become a very important one, I think, over the next 18 months and longer. And then the other tailwind, I suppose, is that Brisbane has won the rights for the 2032 Olympics. So that's going to entail further infrastructure investment. We look at certain areas that may be focused on, and that's within Brisbane, the Gold Coast and the Sunshine Coast, and look at what that may do for the market in general. It's really something that will happen over many years. It doesn't happen, just like Sydney showed us, for a 2 or 4 week period around the event. And then employment growth, the pie, easiest pie. Look at employment growth. Here are some of the ABS numbers since, I guess, the beginning of COVID. So you can have a look at, and we do look at the different sectors, how they've been impacted within states and on a national basis. It gives you a lot more granularity in what sort of people are moving there, where they're finding employment, where they're likely to want to live, what sort of incomes they have. So you can actually go through a lot of data this way to come up with some reasonably compelling trends, I suppose, that you can then follow, and that should give you a better outcome than just making it a haphazard decision. ANZ, all the banks, they got it terribly wrong last year. We actually got it right in terms of what was going to happen to housing prices, and so they've had to upgrade their forecasts on a continual basis for the last 18 months. And I think most of them, again, now share similar outlooks, although we don't know, clearly what's going to happen next year and the year after. I think whilst interest rates remain low, that's going to really support growth assets. And I think, let's face it, if we look at it now, we are probably in a late part cycle of this growth cycle. So real assets tend to generally do a bit better in the late part of a cycle. So that's another tailwind, I think, for property. The value proposition. Well, we try and help people avoid mistakes that people make all the time. So here, buying into a strong market of the future. And we've been doing that or looking at clients and showing them that perhaps that's not a bad idea in southeast Queensland for a number of years. And now you want to just be careful, because I think some of those markets, are tearing away, those coastal markets, and you just want to make sure that you're buying into a strong market of the future rather than buying in, when perhaps you should just be looking at areas where you can still gain that advantage over the next few years. Waiting too long to invest is a classic one, and it sort of relates to the next thing. There's so much information available these days on the internet, and a lot of research, but that doesn't give you knowledge, that just gives you information. And I think what we try and do is help people gain from our knowledge and our experience over time to make more sense of all the information that's available, and that hopefully again will stop them from making mistakes that people commonly do, just following a herd. Ignoring your point of difference. So, I think it's really important. Any investment won't do, and I'll just show you what I mean here. So, don't go and buy an investor-grade small apartment with compromised floor plates in a building with 1,000 apartments in it. Whether that's inner Melbourne or Sydney or the Gold Coast isn't that relevant. There's nothing unique about that, and I think you'll be challenged to get the capital growth that you want. So the other thing is, there was the situation where positive gearing was touted as the panacea for everything, and one-trick ponies, as I call them. So markets that relied on perhaps one industry only would have been very, very good at the time, but is that sustainable in the future? And the answer is probably not. So you've got to look at all these things carefully, and bear them in mind to stop making those mistakes. And then we look at things with further granularity within markets. Supply and demand, as I said, certainly in medium density or higher density housing, there's a long lag period, and as you can see there, the lack of supply, and that's evident now, and it's being exacerbated of late due to the sharp increase in building costs that these builders are facing, up to 25%. Just ask anyone that's building anything at the moment or renovating. It's hard to get labour, and the cost of materials is skyrocketing, and that's going to be further exacerbated by supply chain bottlenecks, getting things into the country. Then look at the distribution of future supply within that market, which we do. And this is something that we've always said to our clients: if you are going to buy an apartment, then we've always thought buying the larger 3-bedroom ones is a better idea. And nowadays also perhaps with a multi-purpose room, because working from home, that tends to also be something that people find an attractive alternative. So that plus the lack of supply, and this number, the 17% currently, still trending around that for this year, is very low compared to 1 and 2 bedroom configurations. Yet it is actually what people want. And a lot of these people are owner-occupiers, not investors. So they're looking to perhaps sell their home, and it's in a sought-after suburb, and it is highly priced. They want to stay in an area like that, but they want the added security and amenity of an apartment. But they would want a large, high-quality, boutique-style building and residence within that, and they can afford to pay for it. So this is something that ANZ did research recently, and look at what people want. It basically says all those things that we've been saying for a while, and it's evidenced by the fact that these things are rented out far more easily than anything else, generally before they're completed. So they're really important things. Putting that all together, buy into an area of strong economic activity, population growth, somewhere where you have already good infrastructure in place and further infrastructure growth occurring. You have sustainable employment growth, and you've got unique attributes of your property which is going to make that sustainable for the future. So you can keep that, because we generally tell the people we talk to, our clients, that they should keep properties that they buy as investments, because they're not made for trading as equities or other mark-to-market instruments, which it's easy and cheap to do. Property is expensive, high transaction costs, and if you do the work up front, do the research, have someone help you, then you can just keep those long term. And what a great way of planning for tax. There is no capital gains tax because you don't sell it. So all of these things are really important, I think, as macro things. These are just from a visual basis to give people an idea of the things we look for. As I say, large residences in smaller boutique buildings in what I call the inner middle ring, sought after suburbs in any capital city market. Townhomes that are, again, in those regions in high quality, harder to find, as are these right sizer apartments. In fact, if you look at what's happening now, particularly in Sydney, the high end of the market, there's a massive shortage in high quality apartments, and prices are rising exceptionally quickly in that dwelling segment. The regional markets, the regional markets, and I'm talking here about the coastal regions, particularly in Queensland, have gone through a boom, are going through a boom, and people, I think, they need to just keep their feet on the ground. The Sunshine Coast, similarly, is really expanding very strongly, and some great fundamentals for that region as well. If you're looking at freestanding dwellings, look at things perhaps in the infill regions, in those, again, inner middle suburbs. So a lot of things to consider when you're doing this research yourself or reaching out for assistance. Something we do is prepare a report that's more quantitative. So, you say, look, here's this property I want to buy. Well, we look at all the costs of acquisition and the ongoing costs of ownership so that you can actually then have a look and see what that looks like. In this example there, you're actually cash flow positive at $90 odd a week. So that gives you a reasonable indication of where things should be. You can have a look at the assumptions that you make within that matrix. So again, I think it's just a good way of knowing that if you're comfortable doing that and it's well within your financial capacity. So this is a good one, because who pays for your property? And normally, up until very recently, since COVID, this was generally the case. So you paid a small portion, the tax man paid a larger portion, the tenant paid the largest. But now you get to this situation where effectively your tenant pays for all of it, and you get to keep all of the excess tax credits, especially if it's a new property, it's quite sizable. It's a pretty attractive situation to look at if you buy the right style of property. So putting all that together, we've done this for quite a long time. We've helped lots of people. We look to efficiently utilise all of the existing legislation, and we like to make sure that you're buying quality properties that have unique attributes and are sustainable. And as I said in the introduction, we have access to higher LVR lending rates, up to 85% for Australian expats, which saves you a great deal of money on mortgage insurance, which you don't need to pay. So without too much further ado, this is what we can do, is looking, if somebody needs advice or wants more information on a personal basis, please reach out and we can assist you with all of these measures. And for now, let's go to Q&A and we'll have a look. There's some questions here in the chat, so let me just have a look at that. Right, so let's have a look here. Question on first home buyer transfer tax exemption. It's very hard to find a property under 650,000. Yes, it is in New South Wales. I agree with that. That's from Ash. So you're probably not going to be a massive beneficiary of that, is the truthful answer. There is a phase out, but look, it's probably not even worth the trouble, I suppose, because with current median prices, if you have a look at anywhere within New South Wales, certainly within Sydney, that's not going to be a major benefit. So this is more, I suppose, designed for young Australians that haven't got anything yet, where, this extra saving could be very beneficial for them, especially when it's added to a saving in mortgage insurance. So that's where it becomes more meaningful. It's not designed really for, clearly, someone who is a property investor, because they're not going to qualify or already has a house. So it's limited. Who else would have a question that they'd like to ask? I have some that people sent in prior. Guy, do you have any questions there?
No, except I sold my Singapore place, Andrew.
You what?
I sold my Singapore place.
Oh, when?
So that only recently, staggering, it's because it's suited to expats with a lot of outdoor space, but of course, unless you're a citizen or a PR, you pay pretty phenomenal buyer's tax, as you know. So
I do.
for 6 months, somebody comes in one morning, end of the day, sold at a pretty good price. Mind you, prices here, if I compare Australia, particular place up in Noosa, it's probably gone up 15% in 10 years, whereas Noosa's tripled, I think, in value.
Yeah. I think.
I will contact you offline. I am interested in looking at something in Brisbane as well. So.
Fantastic. By all means, please do. And it's interesting because if you know different property markets around the world as well, I think it helps a little bit in terms of the overall overarching.
Even in I think the Singapore market, just hasn't followed the rest of the world. It's up a little.
Yeah.
In the last 12 months, but I'm not sure that it's going to do what other markets have done still.
Yeah, I don't think so. I think you've sold well, to be honest. And the more you look at it, Singapore's market is highly controlled, as you know, and the equivalent of stamp duty is excessive, and as we saw a couple of years ago, can be changed in a matter of 3 weeks, substantially. So, and I think the supply and demand situation here also is different to a lot of other European or other Western markets.
I think you're right. It'll depend on do expats come back, because there's been a big outflow. Do they come back? And there's a massive amount of building still going on. I mean, it just hasn't. It stopped for a short time with the foreign workers being kind of locked up in dorms, but it's going at a pace again.
Yeah. No, look, I you only have to look around, you'll see it. The building has continued. 10.7% of the expat population has left. A lot of those would have been takers for those properties. So, there's an imbalance there, which doesn't favour the property owner.
Yeah, there is an interesting question. I think I'll pick it up with you offline. Probably need some analysis. Is how much cash do you throw into a purchase? Let's say in Brisbane now versus how much do you borrow and use your cash other ways? So it'd be a question I have for you. Yeah. That's
a pretty easy one to answer. I'd be more than happy to. You borrow as much as possible at these rates, unless you think the world's going to win. So as much as the bank will give you.
It's almost free money at the moment.
Yeah, that's right.
It's interesting. Again, interesting that my only reason buying here, many years ago was I didn't want to pay high rent and money was free. So money in the rest of the world's now pretty free as well. So.
Well, let's have a chat offline. I look forward to it and be happy to share my thoughts as well.
Thanks.
Ashley, what?
Other questions? Yeah. So, what other incentives, if any, is the government offering for first home buyers who might be, have a higher net worth, higher income?
None.
None?
That's a very easy one to answer. And the reason for that's pretty simple. I think your biggest incentive is to buy something and watch it go up. But, the real reason for all of this was obviously to assist the first home buyer market. And on a selfish basis, I guess, from the government, was to stimulate the economy, which, let's face it, is good for everyone living there. So it really achieved that very well. If you look at the data and the numbers in relation to how many first home buyers over the last 18 months have decided to enter the market, it's amazing. And you can look at that from the provision of credit to that market segment. So it's been substantial, and they don't need to anymore now. And at some point in time, it actually, some people would view it as being counterproductive because it then pushes the affordability envelope higher and higher, and those first home buyers then can't enter the market. So I think that's all happened. It's tailed off. look, there are no real benefits there. As I say, you might have a son or a daughter that's an expat that's in their 20s and they're working overseas somewhere. So it could be good for people like that, right? And certainly, in New South Wales, you're going to struggle. The prices are lower for other states, but then again, the levels that bar set at is below 650, so it's all commensurate. But that's really the only area I see that being of real benefit to someone.
Is there such a trust vehicle as there is in the United States, where you can have an irrevocable trust, its own entity, if you will, act as the Australian resident owner of a property, even if the natural person owners are overseas?
There's all look-through provisions for any property-rich entity, so someone's thought of that way before us.
Okay, yeah, no surprises there. All right, thank you.
You're welcome. But as I say, if you look at the fundamentals, Ash, you don't really need a lot of financial engineering apart from using the things that are at your disposal, which most people don't. They're all legal. So, there are lots of things there where you can basically run a property portfolio on a fairly tax-free basis at the moment until you get probably half a dozen properties. So, that's not a bad outcome. And you don't have to try and over-engineer that. Just use what's available, what's legally available.
Yeah. Well, can you enumerate that list? What is, other than the lower LVR that you're, or the higher LVR that you're talking about, the depreciation?
Yeah, use all of those things, and if you put that together in a spreadsheet, so let's say you have, 4 properties, that could be a saving of extra 200,000 a year. So it's certainly more than pays for everything, because currently a lot of that is going to be, even at those high levels or higher levels of borrowing, cash flow neutral or neutrally geared.
Yeah.
Okay.
The depreciation is just such a bonus.
It's
just
and misunderstood by many Australian expats, because this is not monopoly money, this is real money, and you get to take it home. If you go home and spend it, or if you stay overseas, you can still do that, because you're going to eventually, as properties after say a decade, as you see, rents will increase usually at least in line with CPI. So they'll edge up like this, and you get to a stage where I've got so many clients that say, oh look, I've got a real problem with this property. And I say, what's that? Well, I don't get any more deductions, it's making too much money. So, and I get that. But the reality of that is you can utilize all these free tax credits to keep absorbing that, and then just take that extra free cash flow and use it and spend it. It's a pretty nice outcome.
Good stuff, thank you.
Yeah.
Hey, Shocker, you can take a look at those, the one on the Sunshine Coast and the one at Mermaid Beach that you had in your slides.
Yes. What?
Ready to make it, take a look at them, and we're just looking at options at the moment. So.
Right. Okay. Look, these were just there to give people an idea of the style of properties we look for. Most of the ones at the moment, certainly in those markets, the good ones aren't actually finding their way onto realestate.com, because as I said, it is really that those markets are on a bit of a tear. So you need to probably have contacts within them to make sure that you can actually access that. But please reach out at any stage, and I can certainly give you some details by all means.
Yeah, all right. Very good. And back on that question of expats returning to Singapore and property prices, the unit that we were in, which was a penthouse in Sentosa, just sold for $3.5 million, and it was on the market for 7 years, and they bought it for $8.5 million. So those, the owners must be absolutely crying.
Yeah, that may not be the greatest outcome. Look, Sentosa, over the years, just about every property on Sentosa was for sale, even the ones that were rented out. So I guess, that's been part and parcel of that market.
Thanks for that. I'm feeling much better about myself.
I bet you are. There you go. Fantastic. Any other questions that I might be able to assist with? If not, we'll adjourn for now. And as I say, anyone's very free to reach out, and we can book either a Zoom meeting or a WhatsApp call, whatever the case may be, and I can generally give you a few pointers in the right direction, or assist ourselves. All the very best. Enjoy your Wednesdays or Tuesdays for all the people in the US, and we'll see you. We do weekly Q&A, so if anyone has any questions, by all means do those. Send those in, and we can try and answer them there as well. Melissa, are you well there? All good. All right, all the very best. Take care. See you next time.